Your financial advisor confidently told you that the Backdoor Roth IRA is a legal, straightforward, tax-free way to fund a Roth account regardless of your income. Your tax preparer nodded along when you mentioned it. Your favorite retirement podcast described it as a simple 6-step process. And then April arrived, your tax return was completed, and you discovered that the Backdoor Roth you executed last year cost you thousands of dollars in unexpected federal income tax because nobody ever mentioned the Pro-Rata rule, nobody ever asked about your rollover IRA balance, and nobody ever warned you that the single most popular high-income Roth funding strategy in America quietly becomes a tax trap the moment you have pre-tax money sitting in any traditional IRA. If you are a high-income earner above the Roth IRA contribution phase-out, currently around $165,000 for singles and $246,000 for married filing jointly, and you have been using or are considering using the Backdoor Roth, what I am about to walk you through is the single most important piece of information you need to see before you make another contribution. Because this is not a hypothetical concern. This is the provision in the tax code that has quietly cost tens of thousands of high-earning professionals real money in the past 5 years, almost always unexpectedly. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. Now, let me carefully lay out how the Pro-Rata rule works, why it destroys the Backdoor Roth for some people, and what the available workarounds are. Start with the Backdoor Roth itself. The strategy is based on a gap in the income limits. Roth IRA contributions phase out at specific income levels. Above those levels, you cannot make direct Roth contributions. However, traditional IRA contributions have no income limits. You can contribute to a traditional IRA regardless of income. Whether that contribution is deductible depends on whether you are covered by an employer retirement plan and your income, but the contribution itself is always permitted. Additionally, there's no income limit on Roth conversions. You can convert traditional IRA dollars to Roth IRA dollars regardless of your income. The Backdoor Roth simply combines these two rules. You make a non-deductible contribution to a traditional IRA, then immediately convert that contribution to a Roth IRA. Since the contribution was non-deductible, the conversion is not taxable. The end result is a fully funded Roth IRA contribution, executed through 2 steps, available to earners of any income level. For 2026, the contribution limit is $7,000 plus a $1,000 catch-up at age 50 or older, for a total of $8,000 per person, or $16,000 for a married couple both using the strategy. This all works cleanly in exactly one scenario: when you have a zero balance in any traditional, rollover, SEP, or simple IRA, as of December 31st of the conversion year. That is where the Pro-Rata rule enters. The Internal Revenue Code, through Section 408D2, requires that when you take any distribution from an IRA, the taxable portion is calculated proportionally to the ratio of pre-tax to after-tax money across all your traditional, rollover, SEP, and simple IRAs combined, as of December 31st of the year of the distribution. In other words, you cannot segregate a non-deductible contribution into its own bucket for conversion. The IRS treats all your traditional IRAs as a single pool for purposes of determining how much of any conversion is taxable. Here's the math. Suppose you have an existing rollover IRA with $95,000 from a prior 401k rollover. All of that is pre-tax money. You decide to do a Backdoor Roth. You contribute $7,000 non-deductible to a traditional IRA and immediately convert it to a Roth IRA. Intuitively, you expect no tax because the $7,000 was non-deductible. But the Pro-Rata rule says the IRS treats your IRA pool as $102,000 total, of which $95,000 is pre-tax and $7,000 is after-tax. The ratio is approximately 93% pre-tax. When you convert $7,000, 93% of that amount, or approximately $6,500, is treated as a taxable conversion of pre-tax money. Only about $500 of the conversion is treated as the return of your non-deductible basis. At a 24% federal bracket, plus a 5% state tax bracket, that unexpected $6,500 of pre-tax conversion produces a combined tax of approximately $1,900. You expected zero tax, you got $1,900. Multiply this over several years of Backdoor Roth contributions, and the accumulated unexpected tax can easily exceed $10,000. And here is the subtle, ongoing cruelty. The remaining non-deductible basis that was not used in the conversion, a small portion of it, stays in your traditional IRA and tracks forward on Form 8606 as basis. Every year, you do another Backdoor Roth contribution, the pool remains largely pre-tax and the ratio barely changes. The Pro-Rata continues to apply year after year. The strategy is fundamentally broken for you unless you address the underlying pre-tax IRA balance. Walter, a software architect from Seattle, Washington, ran into this the expensive way. He made $200,000 plus a year, was above the Roth phase-out, and had a rollover IRA of approximately $180,000. From a 401k, he rolled over in 2016 after leaving a prior employer. In 2022, he started doing backdoor Roth contributions, contributing the max each year and converting immediately. He did this for 3 years without understanding the Pro-Rata rule. His tax preparer generated Form 8606 each year correctly, but never mentioned the rollover IRA interaction. Walter finally learned about the Pro-Rata rule when he was about to do his 2025 contribution, and a colleague suggested he look it up first. By that point, Walter had paid an estimated $11,000 of federal and state tax across 3 years on conversions he had assumed were tax-free. He filed amended returns where possible to capture basis, but much of the damage was permanent. The lesson is stark. Nobody is going to check the pro-rata math for you automatically. You have to know the rule. Now let us walk through the available workarounds, because this is where the strategy becomes usable again for people who are currently blocked. Workaround 1. The reverse rollover into an employer 401k. This is the most common and most powerful solution. If your current employer's 401k plan allows incoming rollovers from traditional IRAs, you can roll your existing pre-tax IRA balance into the 401k. Unlike IRA balances, 401k balances are not included in the pro-rata calculation for IRA conversions. By moving your pre-tax money into the 401k, your traditional IRA balance drops to zero as of December 31st, and the backdoor Roth works cleanly with no pro-rata interference. You must execute the rollover with precise timing. The pro-rata calculation uses your IRA balance as of December 31 of the conversion year. That means if you do the rollover before December 31 and your IRA balance is zero on that date, the pro-rata rule does not apply to any conversions done during that same calendar year. The rollover timing is critical. Not all 401k plans accept incoming IRA rollovers. Check with your HR department or plan administrator. Most large company plans do. Some small company plans do not. If your plan does not accept, you may need to explore other workarounds or simply accept that the backdoor Roth is not available to you this year. Workaround 2. Convert the entire pre-tax IRA balance to Roth in 1 or more years. This is the most straightforward path, but also the most expensive. If you convert your $180,000 rollover IRA to Roth in a single year, you pay ordinary income tax on the full amount in that year, which for a high earner can easily exceed $50,000 of federal tax. Spreading the conversion over several years smooths the tax impact but still produces substantial tax. This approach is sometimes the right move if you expect to be in a lower bracket in retirement than you are currently, but for most high earners actively working, the reverse rollover workaround is cleaner. Workaround 3, solo 401k. If you have any self-employment income, even modest amounts, you can open a solo 401k and roll your pre-tax IRA balance into the solo 401k. This is functionally similar to rolling into an employer 401k, but requires some self-employment activity. Freelance consulting, side businesses, writing, and similar independent work can qualify. The solo 401k then shelters the pre-tax balance from pro-rata calculations. Workaround 4, accept the pro-rata and still contribute. For some high earners with very large pre-tax IRA balances relative to their contribution amount, the pro-rata impact is large but not catastrophic. The question becomes whether paying a small amount of tax each year on the converted portion is worth the long-term tax-free growth of the Roth dollars. For younger high earners with decades of compounding ahead, the answer is often yes, even with pro-rata. Run the numbers carefully and decide deliberately. Joyce, a dentist from Boulder, Colorado, used the reverse rollover workaround cleanly. She had $135,000 in a rollover IRA from a prior employer. In October 2024, she asked her current employer's 401k plan if they accepted incoming IRA rollovers. They did. She rolled her entire rollover IRA into the 401k. On December 31st, 2024, her traditional IRA balance was zero. She then executed her 2024 backdoor Roth, contributing $7,000 and converting immediately, entirely tax-free. She has continued the strategy every year since. Over the next 15 years, she expects to contribute approximately $120,000 of Roth basis that would have been blocked by the pro-rata rule if she had not done the rollover first. The lifetime tax-free growth differential is substantial, easily exceeding $100,000 by the time she reaches retirement. Let me walk through the specific execution sequence for a clean backdoor Roth. Step 1. Before any contribution, check your total traditional IRA balances across all custodians. include rollover IRAs, SEP IRAs from any current or prior self-employment, and simple IRAs. Add them up. If the total is 0, you are clean for the backdoor Roth. If it is any positive number, you have a pro-rata issue to address first. Step 2, if you have pre-tax IRA balances and your current employer's 401k plan accepts rollovers, initiate the rollover from the IRA custodian to the 401k custodian. Most custodians have a specific form for this. It typically takes 2 to 4 weeks. Step 3, confirm the rollover is complete and the IRA balance is 0 well before December 31st of the year in which you plan to convert. Leave some buffer in case of processing delays. Step 4, make the non-deductible traditional IRA contribution. You can do this at any custodian. Some people use the same custodian where they hold their Roth IRA for convenience. Specifically designate the contribution as non-deductible if you file Form 8606. Step 5, convert the non-deductible contribution to the Roth IRA. If the contribution and conversion happen the same day, there's little opportunity for any earnings to accrue before conversion. If there is a small amount of earnings between contribution and conversion, that portion will be taxable at conversion, but it is usually a small amount. Step 6, report the conversion on your tax return using Form 8606. This form tracks your non-deductible basis over time and calculates any taxable portion of conversions. Even if no tax is owed, you must file Form 8606. Each year, you have non-deductible contributions or conversions. Missing the form does not usually generate tax, but it can create paperwork problems in later years. Step 7, keep records permanently. Your non-deductible basis in a traditional IRA is tracked cumulatively over decades. If you ever lose track, you may end up paying tax on money you previously paid tax on, which is one of the most painful outcomes in tax planning. Keep every Form 8606 you have ever filed. 3 traps to avoid. Trap 1, forgetting about SIP IRAs and simple IRAs. Many self-employed professionals have SIP or simple IRAs from current or prior business activity. These count in the pro-rata calculation. If you have any, handle them before doing a backdoor Roth. Many can be rolled into a solo 401k if the solo 401k is structured appropriately. Trap 2, forgetting about inherited IRAs. Inherited traditional IRAs from non-spouses do not count in your own pro-rata calculation. They are treated separately under the inherited IRA rules. Inherited IRAs from spouses, if you elected to treat the inherited IRA as your own, do count. Check your specific situation with a qualified tax professional. Trap 3, doing a partial rollover that leaves a small residual pre-tax amount in the IRA. Sometimes, when you roll from an IRA to a 401k, a small pending dividend or interest accrual remains in the IRA after the rollover is initiated. If that residual is not cleaned up before December 31st, the pro-rata rule applies based on whatever balance remains. Work with your custodian to ensure a clean 0 balance by year end, or accept that a small pro-rata impact will occur. Beatrice, a retired professor from Stillwater, Oklahoma, ran into Trap 3. She rolled her rollover IRA into her 401k in November 2023. A small dividend of about $42 was credited to the IRA after the rollover. By December 31st, that $42 sat in the IRA. Her backdoor Roth the following week was subject to pro-rata calculation, but because the pre-tax balance was only $42 and her non-deductible contribution was $7,000, the pro-rata impact was negligible. She paid about $2 of unexpected tax on the conversion, which was insignificant, but the principle matters. Clean up residual balances before year end. Now, let me address a related but distinct strategy that often gets confused with the backdoor Roth. The mega backdoor Roth is a different mechanism based on after-tax contributions to a 401k plan. If your employer plan allows both after-tax contributions and in-service distributions or in-plan Roth conversions, you can potentially contribute substantial additional amounts, well beyond the standard 401k limit, and convert them to Roth. This strategy is not subject to the pro-rata rule in the same way because it operates inside the 401k framework rather than the IRA framework. For high earners with favorable plans, the mega backdoor Roth can move $40,000 to $70,000 per year into Roth accounts. Check with your plan administrator to see whether this is possible in your specific plan. Also worth knowing, the pro-rata rule operates strictly on traditional IRA, rollover IRA, SEP IRA, and simple IRA balances. It does not touch Roth IRA balances, Roth 401k balances, or traditional 401k balances at your current or former employers. This is the precise technical reason why rolling pre-tax IRA money into a 401k resolves the pro-rata issue. The 401k balance is functionally invisible to the IRA pro-rata calculation. Let me also walk through the math on why fixing this is so important. Suppose you are 45 years old, high income, contributing $7,000 a year to a backdoor Roth. If the pro-rata rule is costing you $1,800 a year in unexpected tax on your conversions, that is $1,800 a year of avoidable tax compounding across the remaining 20 years of your career, or roughly $36,000 of tax paid over time. Meanwhile, your Roth contributions of $7,000 a year for 20 years grow into approximately $340,000 of tax-free assets at age 65, assuming a 7% return. If the pro-rata rule had not been in play, those contributions would have been fully tax efficient from the start, and the lifetime savings become clear. 3 concrete action items if you are in the situation. First, pull every IRA statement you have and add up your pre-tax balances. Know the number before you make another decision. Second, contact your current employer's 401k administrator and ask specifically whether the plan accepts incoming rollovers from traditional IRAs. If yes, get the procedure in writing. Third, if you have been doing backdoor Roth contributions without checking the pro-rata rule, pull out every tax return for the past 3 years and confirm with your preparer that Form 8606 was filed correctly and the conversions were handled properly. Amended returns are available for up to 3 years if you discover errors. The backdoor Roth is a genuinely useful strategy when executed cleanly. It becomes a hidden tax liability when executed without regard for the pro-rata rule. Know which category you are in before you make another contribution. If this breakdown helped you avoid a tax surprise, share it with one person in your professional network who is a high earner and might be quietly running into the same issue without realizing it. Subscribe to the channel for the next deep dive in this series, where we walk through the mega backdoor Roth step by step and show you exactly how to evaluate whether your specific plan supports the strategy. Thank you for spending this time here. Take good care of your money, and I will see you in the next one.